Well, welcome to our monthly update on how the Switzer Dividend Growth Fund, or Switzer, is doing. And I'm talking to Marcus Bogdan, who is our portfolio manager. Marcus, thanks for joining us.
Thank you, Peter.
So what's your outlook for the financial year ahead, mate?
I think having a diversified portfolio is incredibly important in this period of time. I do like the companies that have had the strongest earnings recovery in both the banks and the resources. We hold CBA, Westpac, and Suncorp, which I think will deliver a very good uplift in dividends. And we own BHP, which is generating record levels of cash flow. And I think a lot of that will be delivered back to shareholders going forward. So that's underpinned by strong earnings and strong dividend growth. We do like the consumer staples in the portfolio, just given the uncertainties that we're seeing here with the lockdowns we're seeing recently across Australia. So Coles, Woolworths, Wesfarmers, very consistent performers, all have got strong balance sheets and attractive dividend yields. And we've recently added to Endeavour, which was a spin out of Woolworths, which was the retail and hotel business as well. But then we also want to have some investment in the recovery stocks that we're seeing that we expect will be beneficiaries of a more normalised economic activity. And they're companies like Ampol, CSL and Ramsay.
Okay, so how did the portfolio fare last financial year?
So the strongest performers in the portfolio were those ones where you did see a very good recovery in earnings outlook. So Commonwealth Bank, Westpac, Macquarie and BHP were all very strong contributors to the return for the portfolio in the last 12 months.
Okay, so talk us through the activity that took place in the Switzer portfolio during June.
So we added to Amcor and we've added to Endeavour, and we sold a New Zealand company called Chorus. We've added to Amcor. They've had their third upgrade in earnings for the FY21 financial year. They are now expecting earnings per share growth of between 14 and 15%, and that will again translate into a very attractive uplift in dividends. And so that company is performing particularly strongly, and it has lagged the overall share market as well. But with earnings per share growth of double digit on a price earnings ratio of around 15 times and a dividend yield of 4%, we believe that the fundamentals for that company are particularly strong.
Okay. Well, mate, we know last year was a tough year for dividends because the coronavirus and the government policies and basically the request to get the banks on side to help with the economic recovery all affected dividends. But from this position here now, and given your long experience in dividend funds, what are you expecting? And I know it's only a guess at this point because we don't know what's going to happen, but what's your expectation for the dividends before you add in franking? And just give us a feel for what you're hoping to make this year for the Switzer Dividend Growth Fund.
So I think what we'll see in the earnings season coming up in August, the full year earnings season, is earnings per share growth of around 25%, and that will translate into a very good uplift in dividends. And then going forward, consensus earnings is around, for this coming financial year, of around a 12% lift in earnings. And then again, that will translate into a strong recovery in dividends. And so for the banking sector, we do see an improving trajectory in dividends. That uplift will come through in the next results season and the next results season after that as well. But importantly, on very sustainable payout ratios of around 70%. And that recovery that we saw in credit growth yesterday of the housing lending growth of around 7% is testament of why we want to be exposed to the mortgage banks of Commonwealth Bank and Westpac.
Okay. I'm going to try and pin you down. Are you going to be looking at 4% plus franking or 5% plus franking?
So I think we can expect dividend yields of around 4% pre the franking, and then you put the franking on top of that. So compared to that to the cash rate or the bond yield rate, it is still a very attractive return in terms of dividend growth.
Yeah, okay, mate. Well, it's always hard to guess the future, but if that's what you're seeing coming down the pipeline, we'll keep our fingers crossed and let's hope it happens. Thanks for joining us, Marcus.
You're welcome. Thanks, Peter.